Hi, it's Kim Butler. Todd and I are going to do a quick demo on the maximum potential calculator. And this helps answer the question, what builds more wealth? Increasing the rate of return or decreasing your costs? So think about this. Have you ever had a client not meet with you or not want to meet with you again because they're concerned that you are going to take all of their extra money that's impacting their lifestyle right now? Todd, give us a quick demo.
Cool, thanks, Kim. And I would add to that just a little bit. I think even if they are meeting with you, if you haven't addressed this question, I think they still have the question, right? They just, they're more tentative in talking to you probably than they should be, and they're not maybe fully engaged, right? So let's go ahead and put in an illustration period. So we'll put 30 years. And, this is one of those areas where even if we've got an older person, we're going to look 30 years or more out into the future. So I think it's worth keeping that time frame long, regardless of what the age is. Current assets, let's not put any current assets in there at all, and we'll just focus on the income, which is typically what we do when we're talking with our clients. So let's say that we have a couple making $150,000 a year together. And what we see here over this 30-year time frame is $4.5 million cumulatively over that time frame that will flow through this couple's hands. And that's a pretty easy calculation, 30 times 150,000. But I don't think a lot of people understand the seriousness and the value of their ability to work. And that's what this shows is, there's $4.5 million that's going to pass through their hands just over the next 30 years, assuming everything stops at that point in time. But for most people, they're going to also want an increase in their income across that time frame, or expect one for cost of living, et cetera, et cetera. So if we add that, and we'll just go what I would say on the conservative side, if we're looking over a long period of time, of 3% on the annual income increase. And now what we see is that rather than $4.5 million, it's really $7 million. It may have the current value of $4.5 million if inflation is 3%, but there's $7.1 million that's going to actually flow through their hands with a 3% increase in income. Now, what I want to look at is what would happen if we didn't have any expenses at all. We could literally save and invest all of our earned income. And if we did that at, say, a 4% rate net after tax, then what we see is the maximum potential of all of our income earnings across this time frame is $12.7 million, as we can see over there in the compound section. $7.1 million cumulatively just added up, but at a 4% earnings rate, it would have grown to $12.7 million. Now, we know that we can't do that. We do have expenses, and we need to focus and look at how that impacts what we have in the future. So if we look at total taxes, and I mean total taxes, state income tax, federal income tax, sales tax, cell phone tax, everything, then somebody making $150,000 is probably paying somewhere close to 40% in taxes overall for everything that they're doing. And if we look at that, we can see that $2.8 million cumulatively came out of these assets. But since it didn't come out at the end, it came out along the way. What it did was it dropped our future compound maximum potential from 12.7 million down to 7.6 million. So there's actually a $5 million difference in the amount of money we have in the future, even though only $2.8 million was taken away from these assets. And the reason for that is, again, we didn't take it out at the end. We took it out all along the way, so it stopped growing across that time frame. And now if we look at debt service, and if we just use the average American's debt service, I know there was a statistic done that showed 34.5% of the average American's income goes towards servicing debt. If we use that 34.5%, then we see that another $2.4 million went out to service the debt, but the impact was it reduced our future asset value by almost $4.4 million. If we go to lifestyle, and if we use 23.5% for lifestyle, then we see 1.6 million. It's actually the smaller of the three, right? The part that we get. $1.6 million cumulatively had the impact of taking $3 million away from our future assets. So while we saw that big $12.7 million out there as a potential in the future, after we have the expenses of taxes, debt service, and lifestyle, we end up with $274,000. If we look at our last year's income based on that 3% increase, the last year's income would have been $353,000. So it means we don't even have 1 year's worth of income saved across this time frame. We also have over here other costs and inflation that we could add in there. And I don't typically do that, but it is a place that we can play with it. Inflation is one of those numbers that I rarely use on this calculator. It's something that you can use, but I think it can tend to muddy the waters and get away from the real question that we want to ask, which started with what Kim said. What's more important, cash flow or earnings rate? And most people are tuned, because of what we've learned from the financial industry, to focus on earnings rate. So let's do that for a minute. Let's push the earnings rate up. And because most people have heard the idea or think that the way money works is the more risk you take, the more money you end up with. So if we used a 10% earnings rate, now understand that would be net of fees, right? So 10% would be a pretty high earnings rate every single year with no down years all the way out. But if we could do that, then what we see as future savings, $969,000. So what we've really done is, as Kim moves her cursor across there, you can see it pops up automatically. It says 2.7 years of income. So that really doesn't solve the problem. So even if we could do 10% every single year, the problem still exists. And yet that's what a lot of people think is going to save them, is just by earning a higher rate of return. So let's push that earnings rate back down in the 4% range. And let's do this. Let's focus on what's causing the problem. And the problem are the dollars that are coming out of the assets. And yes, we have to pay taxes, but maybe we're paying more taxes than we need to. And if we could get data from you, Mr. Client, then we could see if there's some places that we could help you with that. Maybe we could shift some assets to some more tax advantaged areas, or maybe we could just see where maybe you could take some deductions that are being skipped. So if we could trim 10% off your tax bill, which would mean going from 40% to 36%, not going from 40% to 30%, that would be way more than a 10% reduction in tax. 40%, 10% of 40% is 4, off of your 40 gets you to 36%. If you do that, then you see we end up with $783,000 out there in the future. So that did, and that's 2.2 years of income. So just that one thing right there did almost as much as earning 10% every single year. And yet we were able to do that with a 4% earnings rate instead of the risky 10% that most people are tuned to think is the only way to get there. What if we took this a step further? What if the 10% reduction in our taxes, we started applying against our debt because we started understanding how that works? And what if that had the impact of cutting our debt in half over this whole 30-year time frame? It won't have as much impact up front, but over time it could be tremendous. So what if we reduce that debt service to, say, 18% instead of the 34.5%? Now we have $2.8 million out there in the future, and we're starting to make some real headway. One of the things that's not shown here is, so what could we do potentially with that extra money that's sitting there? Or maybe we're earning more than 4% because we have the opportunity to be able to do that. But now we've pushed our savings to 22.5%, and our lifestyle stayed at 23.5%, which is what it was before, which is what the client was concerned that we were going to be tapping into. So what we'd like to do is be able to find those monies in places where it's currently leaking or going away, and apply that to our future assets. Now, what it means is there's going to have to be some discipline and not just blowing that difference. We need to invest into the future. But with what the individual is currently spending, we can potentially have a drastic impact on their future without chasing interest rates.
Awesome. Thanks so much. So just to summarize, the real benefit of this calculator is to help really a prospect, not that you couldn't also show it to clients, but it helps a prospect see that without impacting their lifestyle, you can make a real difference for them. If you'd like to see what else this calculator can do, join us at Truth Training. Check out the Truth Training tab on the website for the next dates, and we'll see you there.